Imagine selling a profitable asset, but legally postponing the tax bill. Sounds great, right?
It does. And for decades, Section 131 was the go-to for that.
Exactly. This incredibly powerful tool in the U.S. tax code, letting you defer capital gains taxes when you swapped one property for another like-kind one.
And like-kind used to be, well, pretty broad. It wasn't just buildings and land.
Right. That's the key point people might miss now. We're talking a surprisingly wide range of things. Farm equipment, like tractors, even dairy cows or other livestock in some cases.
Corporate jets, rail cars, things people don't immediately associate with 1031.
And even less tangible stuff like patents or trademarks, although that was always maybe a bit more complicated.
Definitely trickier, yes. But the basic idea, the history behind it, was this concept that if you weren't really cashing out...
You were just reinvesting, continuing the investment.
Exactly, just swapping one productive asset for another similar one. The government figured, well, maybe that's not the right moment to tax the theoretical gain. It supported continuous investment.
That historical context is really important, I think. It goes back quite a way in the tax code.
It does. The core idea was, if the investment continues, just in a slightly different form, taxing it felt premature. You hadn't actually realized the cash profit yet. It encouraged reinvestment, keeping capital moving.
Makes sense. But here's where the story takes a pretty dramatic turn. 2018.
Yes, the big shift.
A major piece of tax legislation came into effect, and it fundamentally reshaped Section 1031. The scope got much, much narrower.
Dramatically narrower.
So if you're an investor today and you're holding assets that aren't buildings or land, maybe it's equipment, maybe intellectual property, maybe even something like cryptocurrency, does that 1031 magic still exist for you?
That's the million-dollar question, isn't it?
And if it doesn't, what does that mean for your tax bill? What other strategies do you need to think about?
That change, the Tax Cuts and Jobs Act of 2017, or TCJA, created this huge divide. It didn't kill 1031 completely.
No, it's still around.
But it definitely took a big scalpel to how broadly it could be applied. It preserved the core idea, but only for a very specific category of assets now.
Okay, so let's unpack this for you, the listener. Our mission today, really digging into the source material we have, is to get a solid grasp on this change. We need to understand the history, appreciate how broad 1031 used to be.
Right, the before picture.
Then really focus on that seismic shift with the TCJA in 2017. We'll spend a good amount of time looking at the specific real-world impact on assets beyond real estate, because that's where the rules really changed.
That's where the door basically closed for many types of exchanges.
And then we'll look at the landscape today. What can you do? What other strategies might make sense now that 1031 isn't the universal tool it once was?
Understanding this before and after is, well, it's not just academic. It's crucial for anyone buying, selling, or exchanging business or investment property. The TCJ's impact really depends on the type of asset.
But like you said, 1031 isn't dead. It's still very much alive for certain things.
Absolutely. So maybe the best place to start is to firmly establish what 1031 looks like now, today, for the property it still applies to, which is
real estate. Primarily, almost exclusively, real property.
Precisely. Today, Section 131 lets you defer capital gains tax and also depreciation recapture when you exchange like-kind real property.
Yeah.
And that property has to be held for productive use in a trade or business or for investment.
Key phrase, real property. That's the gatekeeper now.
That's the filter, yes.
And let's be crystal clear for everyone listening. Deferral doesn't mean the tax disappears forever.
Excellent point. It's postponement, not forgiveness. You're pushing the tax bill down the road. The tax on that gain isn't paid now. It gets kind of baked into the tax basis of the new property you buy.
Let's deal with it later.
Usually, yes. That deferred gain, plus any new gain you make on the replacement property, becomes taxable later on. Typically when you eventually sell that property in a regular taxable sale, not another 1031.
Or potentially might get wiped out if you hold the property until you pass away.
Under current law, yes. There's the step up in basis at death, which could eliminate that deferred gain. But the main point is, while you're deferring, you keep that full amount of capital working for you, earning returns.
And the power of just pushing that tax bill down the road,
Yeah.
It can be huge, right? The source material had a pretty stark example.
It really illustrates the motivation. Let's say you sell an investment property and have a really significant profit, maybe $1 million.
Okay.
Without a 1031 exchange, that $1 million gain would generally face federal capital gains tax. That could be, 20% at the top long-term rate?
Plus the net investment income tax, potentially another 3.8% for higher earners.
Right, and maybe depreciation recapture taxed at ordinary rates up to 25%.
So on that $1,000,000 profit, you could easily be looking at a federal tax hit of $250,000, maybe even more, right off the bat.
Absolutely. A quarter of your profit, poof, gone to taxes immediately. That's a huge incentive to use a 1031 if you can.
To avoid writing that $250,000 check.
Exactly. By deferring the tax, you can take the full $1,000,000 and reinvest it into the next property instead of starting over with just $750,000. That allows for potentially much faster growth over time. That extra $250K is still in the game working for you.
And just to recap how that game is calculated, it's the sales price minus your adjusted cost basis, right? Original cost plus improvements minus depreciation you've taken over the years.
Correct. And that depreciation recapture piece, the gain that comes from those past depreciation deductions, that typically gets deferred to in a 1031. So both the capital gain and the recapture can often be pushed forward.
Okay, so for real estate investors, 1031 is still absolutely a core strategy. Let's walk through the main rules and mechanics for these real property exchanges today based on our sources. First, big one, defining like-kind for real estate now. How broad is it?
Well, for real property within the United States, the definition is actually quite flexible. It basically means any real property held for business or investment can be exchanged for any other real property held for business or investment.
So I could swap raw land for an office building.
Yes, or an apartment complex for a retail strip mall, a single-family rental for a warehouse. The specific type of real estate doesn't matter as much as the fact that it is real property used for business or investment.
Improvements don't really matter. A building for land is okay.
Generally, yes. The nature or character as real property is the key. Location within the U.S. usually doesn't disqualify it either. You don't need to swap a Florida rental for another Florida rental.
But you emphasized within the U.S. Is there a catch there?
There is a critical geographical limit. Real property located in the United States is definitively not considered like-kind with real property located outside the United States. That's a hard line. U.S. for U.S. only.
Got it. U.S. property for U.S. property. Okay. Now, most exchanges aren't simultaneous, right? You sell the old place, then weeks or months later, you buy the new one.
Yeah.
The sources say there's a mandatory player involved here.
Absolutely. The qualified intermediary, or QI, sometimes called an accommodator or facilitator.
And they have to be involved in these delayed exchanges.
Mandatory. It's non-negotiable for a non-simultaneous exchange. This whole structure, the delayed exchange, it really came about because of a court case, the Starker case, back in '79. That's why you sometimes hear them called Starker exchanges.
Okay, so why the QI? What's their essential function?
Their role is critical to avoid what the IRS calls actual or constructive receipt of the sales proceeds by you, the taxpayer.
Meaning you can't touch the money from the sale.
Exactly. If you get your hands on that cash, even for a second, or have the unrestricted right to control it, the IRS says, okay, that was a sale, pay the tax. The 1031 deferral is gone. The QI acts as a neutral, unrelated third party to prevent that.
So the buyer of my old property pays the QI, not me.
Correct. The QI holds those funds in escrow or a trust account. Then, when you've identified your replacement property and you're ready to buy it, the QI uses those funds to purchase that property and directs the seller to deed it directly to you. You, the taxpayer, never have direct access to or control over the sale proceeds.
Okay, the QI is like a secure conduit for the money.
Precisely. This interposition, as the regs call it, is what makes the delayed exchange work and keeps it tax deferred. It was formalized in regulations back in 1991.
And connected to this delayed structure are those infamous time limits. You mentioned Starker, and the law kind of reacted to that. How strict are these deadlines?
Incredibly strict. This is probably the #1 way people mess up a 1031 exchange. They are absolute, unforgiving deadlines.
Okay, lay them out for us.
Once the closing happens on your relinquished property, the one you're selling, 2 critical clocks start ticking at the same time. First, the 45-day identification period. Within exactly 45 calendar days from closing on the old property, you must formally identify in writing the potential replacement properties you might buy. You deliver this identification to the QI.
And there are rules about how many properties you can identify.
Yes, the sources detail a few options. The most common is the 3-property rule. You can identify up to 3 properties, regardless of their value, or there's the 200% rule. You can identify more than 3, but their total fair market value can't be more than double the value of the property you sold.
Okay.
There's also a less common 95% rule, which says if you identify more properties under the 200% rule, you generally have to actually acquire at least 95% of the total value of all the properties you identified. So the 3-property rule is usually simplest.
45 days to point to the potential targets. What's the second clock?
The 180-day exchange period. You have a total of 180 calendar days, again, starting from the closing date of your relinquished property, to actually acquire and take title to one or more of the replacement properties you identified within that first 45-day window.
So 45 days to identify, 180 days total to close on the new one. And you said calendar days. What if day 45 or day 180 falls on a Sunday or a holiday? Tough luck.
Tough luck, exactly. No extensions for weekends or holidays. If the deadline falls on that day, it's due that day. You can't wait until Monday.
Wow. What about other issues? Like, what if the property I identified gets damaged after day 45 or the seller backs out?
Generally, still no extension. Once that 45-day identification period closes, you're pretty much locked into the properties you identified. If something goes wrong with them later, you might fail the exchange unless you identified backup properties within the 45 days and can close on one of those within the 180 days.
So the only real exception is?
The only common one is if you're directly affected by a presidentially declared disaster area. The IRS often issues specific guidance granting extensions in those limited situations. Otherwise, miss the deadline, break the exchange, pay the tax.
And that really emphasizes needing to plan ahead. You almost need to know what you want to buy before you even sell.
It definitely helps. It requires a lot of preparation and being ready to move quickly in the market.
Okay, let's switch gears a bit to boot. Hear that term a lot with 1031s. What is boot and why do people try to avoid it?
Boot is just the informal tax slang for any cash or other non-like-kind property you receive in what's supposed to be a like-kind exchange.
Stuff that isn't the replacement real estate itself.
Right. While the goal of a 1031 is usually to defer all the gain by trading solely for like-kind property of equal or greater value, sometimes you end up receiving some boot. And the rule is simple. Your gain is recognized, meaning it becomes taxable now, up to the amount of boot you receive.
So if I have that $1 million potential gain, but I receive $100,000 in cash boot,
then $100,000 of that gain is immediately taxable in the year of the exchange. Your realized gain was $1, but your recognized taxable gain is $100K because of the boot. The remaining $900K might still be deferred, assuming the rest of the exchange qualifies.
what are common ways people end up with boot?
Several ways. The simplest is cash boot. Maybe the property you buy costs less than the net proceeds from the property you sold. The leftover cash comes back to you from the QI, that's boot. Then there's mortgage or debt reduction boot. This one trips people up a lot. If the mortgage you take on for the new property is less than the mortgage that was paid off on the old property, that difference, that debt relief, is considered boot.
So sell a place with a $500 K mortgage, buy a new place with only a $300 K mortgage. That $200 K difference is taxable boot.
It is, unless you offset it. You can offset debt relief boot by adding an equivalent amount of your own cash into the purchase of the new property.
Ah, okay.
To fully defer gain and avoid boot, the general rule is you need to acquire replacement property of equal or greater value, and you need to replace both the equity you had and the debt you had. You can use cash to make up for lower debt on the new property, but you cannot use more debt on the new property to offset receiving cash boot.
So more debt doesn't cancel out taking cash out.
Correct. Receive cash or have a net reduction in debt that you don't cover with new cash, and you've got boot. Other things can be boot too. Receiving significant personal property along with the real estate, maybe furniture or equipment, if its value is too high relative to the real estate. Or using exchange funds held by the QI for non-qualified expenses, like paying for repairs on the new property instead of using separate funds.
That debt boot rule seems really important to watch. Need to trade equal or up in both value and debt equity. How does receiving boot, or maybe paying boot if you buy a more expensive property, affect the tax basis of the new place?
Right, the basis calculation keeps track of the deferred gain. In simple terms, the basis of your new replacement property generally starts with the adjusted basis of the old property you gave up. Then you add any cash boot you paid, like if you bought a more expensive property, or any increase in mortgage debt you took on. You subtract any cash boot or debt relief boot you received. And importantly, you add back any gain you had to recognize because of the boot you received.
Okay, that sounds complicated.
It can be, but the goal is straightforward. The final basis of the new property should be structured so that the amount of gain you successfully deferred is preserved. It's built into that new, usually lower basis, ready to be taxed if and when you eventually sell the replacement property in a taxable transaction. It ensures the tax isn't lost, just postponed.
Got it. Okay, before we leave real estate, a couple of specific scenarios mentioned in the sources. What about my beach house? Can I use 1031 for a second home or vacation property?
That's a super common question, and the basic answer is no, your personal residence does not qualify. Section 131 is very clear. The property must be held for productive use in a trade or business or for investment.
What, is there a but?
There is a but. A second home can potentially qualify if you genuinely treat and use it as an investment property, not primarily for personal fun. The IRS actually provided a safe harbor, a set of guidelines, back in 2008, Revenue Procedure 2008-16 on how to do this.
A safe harbor. So if I follow these rules, the IRS will generally accept it as investment property for 1031.
That's the idea. To meet this safe harbor, for each of the two 12-month periods before the exchange and for each of the two 12-month periods after the exchange, the property needs to meet two key tests.
Okay, where are they?
1. You have to rent it out at fair market rent for at least 14 days in that 12-month period.
Minimum rental days. Got it.
2. Your personal use of the property can't exceed the greater of 14 days or 10% of the number of days it was actually rented out at fair market value during that 12-month period.
Strict limits on personal use.
Very strict. And there are rules about renting to relatives too. Generally has to be their main home and at fair market rent. Plus, you need to be reporting the rental income and expenses on Schedule E of your tax return, treating it like a real rental property.
So you really have to run it like a business, not just a vacation spot you occasionally rent out. You need records for 2 years before and 2 years after the exchange.
Precisely. Compliance with those usage days is key to fitting into that held for investment box under the safe harbor.
Okay, one more real estate wrinkle. Reverse exchanges. Sounds like doing things backwards.
Exactly. In a standard or forward exchange, you sell your old property first, then buy the new one. In a reverse exchange, you actually acquire the replacement property before you sell your existing relinquished property.
Why would someone do that?
Maybe you find the absolute perfect property you want to buy, and you need to close on it now before you even have a buyer lined up for your old place. Or maybe the seller of the new property won't wait.
Okay, but how does that work? You can't just own both properties at the same time during the exchange, right? Sounds like it breaks the rules.
It does pose a problem. This is where a concept called parking comes in, which was also given a safe harbor structure by the IRS in Revenue Procedure 2037. Since you, the taxpayer, can't hold title to both the old and new properties simultaneously, you use a special entity, often related to the QI, called an Exchange Accommodation Title Holder, or EAT.
An EAT, like the QI, but for reverse exchanges.
Sort of. The ET temporarily parks or holds title to one of the properties involved. Either the EAT acquires and holds title to the new replacement property you want to buy until you can sell your old one.
Okay.
Or sometimes the ET takes title to your old relinquished property, allowing you to go ahead and acquire the new replacement property directly. The ET holds whichever property needs to be parked to make the exchange work within the rules.
And do those same crazy time limits apply? 45 days, 180 days?
Yes, absolutely. The clocks start ticking from the date the EAT takes title to the park property. From that date, you generally have 45 days to formally identify the property that will be relinquished if the EAT parked the new property, or the property that will be the replacement, though usually the replacement is acquired first. And you have the full 180 days from when the EAT took title to complete the entire transaction, meaning sell the relinquished property and have the EAT transfer title of the parked property appropriately.
It sounds even more complex and probably more expensive than a regular exchange.
It definitely is more complex, often involves bridge financing, and has higher fees. But it's a valuable tool when the timing just doesn't work out for a standard forward exchange.
Okay, so 1031 for real estate. Still powerful, still complex, lots of rules. Strict deadlines, scenarios like second homes and reverse exchanges possible, but tricky. But the main event for this deep dive is what happened beyond real estate, the TCJA, 2017.
Right. This is where everything changed for a lot of businesses and investors who regularly traded assets other than buildings and land. before the TCJA changes kicked in.
Which was January 1st, 2018, effectively.
Yes, for exchanges completed after December 31st, 2017. Before that date, Section 131 was, as the source material says, applicable to a wide array of property. It covered tangible, personal property, think equipment, machinery, vehicles, livestock.
A farm tractor, the corporate jet.
Exactly. And also intangible property patents, trademarks, copyrights, franchise licenses, maybe even things like broadcast licenses or fishing quotas. As long as it was held for business or investment and you exchanged it for property of a like kind.
The idea was the same. Continuous investment, no cashing out.
Pretty much. A farmer trading an old tractor for a new one wasn't seen as realizing a taxable profit in the same way as selling it for cash. They were just continuing their farming operation with an updated tool.
And then, bang, TCJA 2017 hits. What did it do?
This is the core of it. The Tax Cuts and Jobs Act explicitly repealed the application of Section 1031 for all types of property except real property. Full stop.
Wow. So it just carved everything else out? Personal property, intangibles, gone.
Gone. Effective January 1st, 2018, with a small transition rule for exchanges already in progress at the end of 2017. But for any exchange started and completed in 2018 or later, if it wasn't real property, 1031 was off the table.
So the answer to our headline question, 1031 beyond real estate, is basically no, not anymore.
For the vast majority of situations today, that's the clear answer. The door slams shut.
Let's dig into the impact. Start with tangible personal property equipment, vehicles. The source used that farm tractor example, which really highlights the difference. What was the deal before 2018?
Okay, pre-2018. Farmer has an old tractor, fully depreciated, so its tax basis is zero, but it's worth $75,000 as a trade-in. Farmer trades it in plus pays $50,000 cash to get a brand new tractor worth $125,000. Under the old 1031 rules for personal property, that $75,000 gain, the trade-in value minus the zero basis, was deferred. No tax paid now.
Yeah.
The tax basis in the new $125,000 tractor wasn't its full cost. It was calculated as the old basis plus the cash boot paid $50 a day. So the new tractor started with a $50,000 basis for depreciation purposes. The Section 1245 depreciation recapture on the old tractor was also rolled over and deferred.
So no immediate tax hit on that $75K gain.
Yep.
The basis just carried over, adjusted by the cash paid. Now, same farmer, same deal, but it happens in 2018 or later. What's the result after TCJA?
Total different tax treatment. It's no longer viewed as a single non-taxable exchange. The law now forces you to treat it as two separate events. A taxable sale of the old tractor and a separate purchase of the new one.
Okay, walk me through that with the numbers.
The farmer is treated as having sold the old tractor for its fair market value, the $75,000 trade-in allowance. Since the basis was zero, the farmer has a $75,000 recognized gain on that sale. And because the tractor was depreciated, this gain is typically Section 1245 recapture.
And Section 1245 recapture is taxed how?
At ordinary income tax rates, not capital gains rates. So depending on the farmer's bracket, that could be taxed as high as 37% federally. That $75,000 gain goes right onto Form 4797 and hits their taxable income.
Ouch, that's a massive change. Just trading in equipment triggers an immediate ordinary income hit. That seems way worse than the old system.
It definitely changes the upfront tax calculation significantly. However, and this is a big however, the sources point out, the TCJA also made some major enhancements to depreciation rules around the same time, which can help offset this.
You mean bonus depreciation and Section 179 expensing?
Exactly. The TCJA temporarily boosted bonus depreciation to 100% for qualified property and, importantly, made it apply to used property acquired after September 27, 2017, though that 100% is now phasing down year by year. It also permanently increased the Section 179 expensing limit significantly. It's over $1 million now, indexed for inflation.
So how does that help the farmer?
Well, remember, the second part of the transaction is now treated as a separate purchase of the new $125,000 tractor.
Right.
That new tractor's basis is its full cost, $125,000. Since it's treated as a purchase, the farmer might be eligible to immediately expense that entire $125,000 cost using 100% bonus depreciation, if applicable in the year, or Section 179.
Wait, so the farmer has $75,000 of ordinary income from the sale of the old tractor,
Right.
but potentially a $125,000 ordinary deduction from expensing the new tractor.
Precisely. In that scenario, the $75,000 gain is more than wiped out by the $125,000 deduction. The net effect on federal taxable income in that year could be a $50,000 loss. $125K deduction minus $75K gain.
So federally, the immediate income tax impacts might end up being zero or even negative.
Correct. This is what the sources mean when they say the enhanced depreciation rules help soften the blow of repealing 1031 for personal property. The upfront federal income tax might look similar or even better in some cases.
Is it really the same as 1031? It feels different somehow? Are there other implications?
You're right to question that. It is not the same. And there are important differences beyond just that year's federal income tax. One big one, especially for sole proprietors or partners, is the impact on self-employment SE tax.
How did that come into play?
The $75,000 Section 12245 recapture gain from the sale of the old tractor, while taxed at ordinary income rates, is generally not subject to SE tax. It's reported on Form 4797, typically outside the SE calculation.
Yeah.
But the big $125,000 depreciation or Section 179 deduction is taken against the farmer's business income, like on Schedule F. And Schedule F net profit is subject to SISD tax, Social Security, and Medicare.
So the gain doesn't increase SE income, but the huge deduction reduces it.
Exactly. So while your income tax might be low or zero, you could see a significant reduction in your net self-employment earnings reported for SE tax purposes in that year.
Which means paying less SE tax now, but potentially getting lower Social Security or Medicare benefits later on.
That's the potential long-term trade-off. Lower SE earnings today mean lower contributions credited for future benefits. The sources also mention a potential link to the Section 199A Qualified Business Income QBI deduction. While the Section 1245 gain might qualify as QBI, the large offsetting depreciation deduction definitely reduces your overall QBI, which could lower your QBI deduction. It's complicated.
And then you layer on state taxes. You mentioned earlier states don't always follow federal rules.
This is where it can become a real headache. Many states do not automatically conform to all federal tax changes. The sources specifically mention California having partial conformity, still allowing personal property 1031 for some taxpayers, and Iowa potentially not conforming to either the repeal of personal property 1031 or the enhanced federal depreciation rules.
So let me get this straight. Federally, my tractor trade-in might result in $75K gain offset by $125K depreciation, maybe no federal income tax. But in my state, say Iowa, based on the source, it might still be treated as a tax-deferred 1031 exchange under state law.
Potentially, yes. Or the state might recognize the gain but not allow the large federal depreciation deduction. You could end up with zero federal tax but still owe state tax on the gain. Or have different depreciation schedules for state versus federal purposes going forward.
That sounds like a nightmare for accounting.
It adds significant complexity. Businesses exchanging personal property now absolutely must check their specific state's conformity rules for both 1031 and depreciation. You could be filing very different calculations for federal and state returns based on the same transaction.
Okay, so tangible personal property, no more 1031, now a sale and purchase. Gain potentially offset by depreciation, but watch out for SE tax and state tax issues. What about intangibles, patents, copyrights, trademarks, that sort of thing?
Before 2018, exchanges of intangible personal property could technically qualify for 1031, but as we hinted earlier, it was already very difficult and restrictive.
Why was it so hard even back then?
The IRS regulations had a very tough two-part like-kind test, specifically for intangibles. First, the nature or character of the rights involved had to be the same, so maybe a patent for a patent or a copyright for a copyright. That part was usually manageable.
Okay. What was the second part?
The second, much harder part was that the nature or character of the underlying property to which the intangible related also had to be substantially the same.
Underlying property, what does that mean for something like a patent?
Exactly. That was a problem. The sources mention an IRS ruling where a company tried to group patents into broad categories like process patents or machine patents and exchange them. The IRS said, no, you have to look at each patent individually and compare the specific underlying technology or invention. Is the invention underlying patent A fundamentally similar to the invention underlying patent B?
So you couldn't just swap a patent on, say, a drug formula for a patent on a software algorithm?
Almost certainly not. The underlying property, the chemical compound versus the computer code, is completely different. Same for swapping a copyright on a novel for a copyright on a musical composition. The rights are similar, copyright, but the underlying creative work is different. It required a very granular item-by-item comparison.
So it sounds like it rarely worked even before the TCJA.
It was a very high hurdle, and many proposed exchanges likely failed the test.
And now, post-2018, Same fate as tangible personal property.
Exactly the same. As of January 1st, 2018, Section 931 simply does not apply to exchanges of intangible property, regardless of how like-kind they might seem. Any exchange is now treated under general tax principles as a disposition, meaning gain or loss is recognized.
Okay, so the post-TCJA picture is stark.
Yeah.
Outside of real estate, 1031 is basically gone. Exchanges are taxable. Depreciation might help with tangibles, but brings its own issues. States add complexity. Now, let's tackle a new kid on the block, asset-wise, cryptocurrency.
Crypto. A perfect example of how tax law struggles to keep up with technology. But regarding 1031 today, the answer for crypto is actually very clear, thanks directly to that TCJA change.
What's the definitive answer for crypto exchanges happening now, post-2018?
Unequivocally no. Based on federal law after the TCJA, exchanges of one cryptocurrency for another do not qualify for 1031 like-kind exchange treatment.
Why not?
Because cryptocurrency is not real property. And as we just established, Section 131 after January 1, 2018 only applies to real property. Since crypto is considered personal property, specifically intangible personal property, the repeal of 1031 for those categories applies squarely to it.
So swapping Bitcoin for Ethereum today is just like selling the Bitcoin and buying Ethereum.
Exactly. It's a taxable event. You have to calculate the gain or loss on the Bitcoin you disposed of based on the fair market value of the Ethereum you received at the time of the swap compared to your basis in the Bitcoin. That gain or loss is reportable and taxable in the current year. Same if you use crypto to buy goods or services, that's a taxable disposition of the crypto.
Okay, clear as mud for today. But before 2018, when 1031 did still apply to personal property, this must have been a huge gray area, right? The IRS hadn't issued specific guidance on crypto in 1031 back then.
Oh, absolutely. Massive ambiguity. We knew from IRS guidance in 2014, notice 2014-21, that virtual currency was treated as property for tax purposes, not currency. Since it wasn't real property, the question became, could one crypto be like-kind to another under the rules for intangible personal property?
Which meant applying that really tough two-part test we just talked about.
Yeah.
Same rights, same underlying property.
Precisely. And trying to apply concepts designed for patents or copyrights to decentralized digital assets with no clear underlying property in the traditional sense. Well, it was incredibly challenging. How do you determine if Bitcoin is like-kind to Litecoin or Ethereum or Ripple under those rules?
What did people even look at? How did they try to make the argument?
Tax pros and taxpayers had to look for analogies. They examined existing IRS rulings and court cases dealing with the like-kind nature of other unique assets, particularly things that might function similarly to currency or stores of value. The sources mention some fascinating analogies drawn from IRS rulings about exchanging gold coins.
Gold coins. How does that relate to crypto?
It shows how the IRS historically approached like-kindness when assets weren't identical but might serve similar functions. For instance, the IRS ruled on bullion for bullion. Mexican gold pesos for Austrian gold coronas could be like-kind if both were valued primarily based on their gold content.
Okay, value based on the underlying metal.
But bullion versus numismatic. U.S. $20 gold coins, valued for rarity collectability, were not like-kind with South African Krugerrands, valued for gold content. Different bases of value.
Rarity versus metal content. Different natures.
Bullion versus non-circulating legal tender. Gold bullion could be like-kind to a Canadian maple leaf coin, which is legal tender, if the coin wasn't actually used as currency and was valued solely for its gold content.
Function matters.
Gold versus silver. Gold bullion was not like-kind to silver bullion. Even though both are metals valued by weight, they're intrinsically different commodities.
Different underlying asset.
Currency versus numismatic. Regular circulating Swiss francs were not like-kind to collectible U.S. gold coins. Totally different function and nature.
Okay, I see the pattern. The IRS look really deeply at the fundamental nature, the function, the basis of value, the underlying asset itself, not just the superficial form.
Exactly. So trying to apply that logic, plus the intangible property test, to pre-2018 crypto swaps meant asking really tough questions. What's the core function? Is crypto A primarily a store of value, like Bitcoin is often seen? Is crypto B mainly a medium of exchange? Does crypto C have a specific utility on a platform? What's the underlying property? Is it the specific blockchain protocol, the consensus mechanism, proof of work versus proof of stake, the network itself? How similar do these need to be? Is Gitcoin's blockchain like-kind to Ethereum's, given Ethereum's smart contract capability? Probably not. What's the basis of value? Is it network security, transaction speed? Is a stablecoin pegged to the dollar like kind to a volatile altcoin? Unlikely. Are the rights the same? Do they grant the same abilities to transact, hold, stake, or govern?
So maybe you could have argued pre-2018 that swapping Bitcoin for Litecoin was like-kind if you focus on them both being proof-of-work stores of value.
That might have been one of the stronger arguments, relatively speaking. But swapping Bitcoin for, say, an Ethereum-based DeFi governance token or an NFT, that seems like a much harder case to make. The function, underlying tech, rights, basis of value all seem vastly different.
It sounds like even before the law changed, getting 1031 treatment for crypto swaps was uncertain at best.
Highly uncertain. And the lack of clear IRS guidance specifically on Crypto 131 meant anyone taking that position was relying on interpretations of old rulings about different asset types. Plus, adding to the confusion, there were apparently conflicting public statements from IRS officials back then, some hinting it wouldn't qualify, others saying, maybe, depends on the facts. It was definitely murky.
So the past was foggy, but the present, thanks to TCJA, is crystal clear.
Absolutely. Post-2018, no ambiguity. Crypto-to-crypto exchanges are taxable events, period.
Okay, so we've covered the big shift. 1031, now mainly real estate, personal property, intangibles, crypto. Generally taxable exchanges now, with potential depreciation offsets for tangibles bringing new complexities. This really changes the game for investors holding appreciated assets. Even real estate investors might look for other options. What alternatives or complementary strategies are out there, according to the sources?
That's a really important part of the picture now. Since 1031 is limited or sometimes just not the right fit, investors need to know about other tools. The sources highlight several strategies, each with different goals and tax outcomes. And it's crucial, as the sources stress, there's no single best one. It's about finding the best fit for your specific situation.
Your goals, risk tolerance, need for liquidity, desire for active versus passive management, all that plays in.
Exactly. Let's touch on some of the main ones mentioned. First up, UPRATs using a Section 721 exchange.
UPRTET, Umbrella Partnership.
So, Real Estate Investment Trust. Right. This structure allows a property owner to contribute their property directly to a partnership, usually the operating partnership of a REIT, which could be publicly traded or private. In return, they get partnership units, not cash.
And that contribution, that swap of property for partnership units, is the Section 721 exchange.
Generally, yes. Section 721 of the tax code allows contributions of property to a partnership in exchange for partnership interest, usually on a tax-deferred basis. So, similar effect to 1031, you defer the gain on the property you contributed.
What's the appeal of doing that instead of a 1031?
Often it's diversification. You go from owning one property to owning units representing a small piece of a large, diversified portfolio of properties held by the REIT. Plus, if the REIT is publicly traded, those units might eventually become sellable on the stock market, offering potential liquidity down the road. The tax is deferred until you sell the units.
Interesting. Deferral plus diversification and potential liquidity.
Okay.
What about Delaware statutory trusts, DSTs? Heard a lot about those recently.
DSTs have become very popular, especially in the 1031 context. An IRS ruling in 2004, Reverend Rule 2004-86, explicitly approved them as qualifying replacement property for 1031 exchanges.
So what is a DST?
It's a legal trust structure that holds title to real estate, typically large commercial properties like apartment buildings, shopping centers, medical offices. Investors buy fractional interests, beneficial interests in the trust. So you own a piece of a large, often institutional quality property. A sponsor company finds, buys, manages, and finances the property within the DST.
So it allows smaller investors to get into bigger deals, and it's professionally managed.
That's the main appeal. Passive ownership, access to potentially higher quality assets. But it's critical to understand, as the sources note, investing in a DST by itself, just putting cash in, is not tax deferred.
So the DST itself isn't the deferral strategy.
Correct. The DST is important because it's an eligible replacement property you can buy as part of a Section 31 exchange.
Got it. So I sell my rental house, and instead of buying another house, I use the 1031 proceeds to buy an interest in a DST that owns a portfolio of office buildings.
Exactly. You use the DST interest to complete your 1031 exchange, achieve the tax deferral, but effectively transition from being an active landlord to a passive real estate investor. It's a tool within the 1031 framework.
That makes sense. A way to stay invested in real estate via 1031, but change the management burden. Okay, next strategy. Tenants in common cash out. Sounds like it's about getting money out.
It is. This applies specifically when a property is already owned by multiple co-owners as tenants in common, TSMEs, each holding their own fractional deeded interest. If the property is owned free and clear or has significant equity, the TEAT owners might collectively decide to refinance it, put new debt on the property.
And the cash from that refinance loan.
Gets distributed to the TIGA owners based on their ownership percentage. Since loan proceeds aren't typically considered taxable income, this allows the investors to pull tax-free cash, liquidity, out of their investment while still owning their share of the property. It's purely a liquidity strategy, not related to deferring gain on a sale.
Right, accessing equity without selling. Okay, how about a deferred sales trust? The name implies delaying tax.
It does, but it works differently than a 1031. With a deferred sales trust, DST, confusingly, same acronym as the Delaware structure, but different concept, you do sell your property. But instead of getting all the cash at closing, the buyer pays the proceeds over time into a special trust managed by a third-party trustee. That trust then makes installment payments to you, the seller, over a pre-agreed schedule.
So it's basically a structured installment sale using a trust.
Essentially, yes. The gain on the sale is eventually taxed, but it's recognized gradually as you receive the payments from the trust over potentially many years.
So it doesn't defer the tax indefinitely like 1031 potentially could. It just spreads the tax liability over time.
Exactly. It's a tax spreading or tax timing strategy, making the tax hit more manageable by breaking it into smaller pieces over multiple tax years. Useful if you want to sell, but don't need all the cash up front and want to avoid a huge tax bill in 1 year.
That's a key difference.
Yeah.
Spreading versus deferral.
Yeah.
Got it. Another one created by the TCJA, Qualified Opportunity Zone Funds, QOFs.
Right. Opportunity zones. These were designed to spur investment in economically distressed communities. The tax benefits are quite different from 1031, but potentially very powerful. The first key thing is you can invest capital gains from the sale of any type of asset, stocks, bonds, a business, artwork, crypto, real estate into a QOF.
Any capital gain qualifies, not just real estate.
Correct. Any capital gain if invested into a QOF within 180 days. If you do that, you get to defer recognizing that original capital gain.
Until when?
Until the earlier of when you sell your QOF investment, or December 31st, 2026. So it's a temporary deferral of the original gain.
Okay, deferral until 2026 at the latest. What else?
There are potential benefits for holding the QOF investment longer. If you hold it for at least 5 years, 10% of that original deferred gain is forgiven, excluded from tax. Hold it for 7 years, and 15% is forgiven.
A potential reduction on the original gain tax. Interesting.
But the biggest potential benefit comes if you hold the QOF investment for 10 years or more.
What happens then?
Any appreciation, any capital gain on the QOF investment itself can potentially be excluded from federal tax entirely when you eventually sell the QOF investment. That's huge potential tax-free growth on the new investment after 10 years.
Wow. So defer the original gain, maybe get a discount on it, and then potentially pay zero tax on the QOF's growth after 10 years. That's pretty compelling. State issues here too, though.
Yes, unfortunately, state conformity is again a major issue. The sources mentioned California and several other states haven't conformed to the federal QAZ rules. So you might get all those nice federal benefits, but still owe state capital gains tax on the original gain you deferred federally, and maybe even on the gain from the QOF investment later. State taxes can really complicate QOF planning.
Always got to check the state rules. Okay, lastly, the sources list direct purchase of triple net leased NNN properties.
NNN properties are a specific flavor of real estate investment. Typically a single-tenant building, maybe a drugstore, fast food restaurant, or small office under a long-term lease where the tenant pays for almost everything. Property taxes, insurance, and maintenance, the triple nets.
So the landlord role is pretty passive.
Generally, yes. It's often attractive to investors looking for steady income with minimal management hassle. Now, just buying an NNN property isn't a tax deferral strategy in itself.
Right. But like DSTs, it's relevant because it can be used as replacement property in a 1031 exchange.
Precisely. NNN property is considered like-kind real property. So if you sell, say, an apartment building you were actively managing, you can do a 1031 exchange and buy a NNN property to defer the tax while shifting to a much more passive investment structure. You can buy them directly or sometimes through fractional ownership structures that also qualify for 1031.
Okay, so it seems like even with 1031 narrowed, there's this whole ecosystem of other strategies, UPRITEs, DSTs, QOFs, NNNs, deferred sales trusts, TIC cash outs targeting different goals, deferral, tax spreading, liquidity, diversification, passive income.
Absolutely. And the sources mention specialized firms that help investors navigate these, particularly things like DSTs or structured TICs, finding suitable properties and handling the complex paperwork to make sure they qualify for 1031 or other strategies.
It really hammers home that point from the source material.
Yeah.
There's no single best option.
Not even close. It's all about the best fit for the individual investor's circumstances, their goals, their risk appetite, their timeline, their need for cash flow versus growth. Making the right choice requires really understanding these options, their tax consequences, and, as the sources strongly suggest, getting good advice from qualified tax and financial professionals.
Okay, so we've traced the history, seen the big TCJA impact beyond real estate, detailed 1031 for real estate today, covered the new reality for personal property, intangibles, and crypto exchanges, and explored these alternatives.
Yeah.
What's the big picture look like now? Any lingering threats or future thoughts on 1031? Even the real estate version?
Well, the current landscape is definitely clearer in one sense. The rules for non-real estate are pretty fixed now, mostly taxable. But overall planning is arguably more complex because of those state tax disconnects, the interplay with appreciation, and needing to weigh 1031 against this whole menu of other strategies like QOFs or DSTs. And even the real estate 1031 isn't necessarily safe forever.
Still faces potential challenges or changes.
Yes. The sources mention the political reality. Section 131, even just for real estate, comes up periodically in D.C. discussions about tax reform. It's sometimes labeled a loophole for the wealthy and targeted as a potential pay-for, a way to raise revenue to fund other government spending.
What are the arguments against it? Tax avoidance?
That's often the framing, that it allows wealthy investors to indefinitely avoid taxes on real estate gains.
And the defense? What do supporters say?
Supporters, particularly from the real estate industry, push back hard. They argue it's a vital economic engine, not a loophole. They say it encourages transactions, keeps capital flowing into new investments, upgrades properties, creates construction jobs, generates property taxes, transfer taxes, income taxes, essentially stimulating the economy in many ways. They see it as promoting market liquidity and efficient use of capital.
Sounds like a perennial debate.
It really is. And tax laws are always subject to change. The sources even mention a past proposal under the Trump administration about allowing immediate expensing for buildings that could have dramatically changed the calculus and maybe made 1031 less necessary or attractive. That specific idea didn't happen, but it shows alternative approaches are always possible.
So while the biggest change limiting it to real estate seems settled for now, the whole area of asset exchanges and tax planning remains really dynamic.
Absolutely. The complexity introduced by the TCJA, combined with state issues and the rise of alternatives, means careful, sophisticated planning is more critical than ever when disposing of any significant asset. You have to know if 1031 even applies, and then if it's truly the best path compared to everything else available to meet your goals in the current tax environment.
Definitely not simple anymore.
Far from it. A complex web indeed.
Okay, this has been a really comprehensive deep dive. We've gone from the broad history of 1031 through the huge 2017 TCJA shakeup for non-real estate assets, detailed the current rules for real estate, faced the taxable reality for equipment, intangibles, and crypto swaps, and explored that whole landscape of alternative strategies. Let's try to boil down to the key takeaways for our listeners.
Sounds good. First, the big one. Section 131, after the 2017 TCJA, is now fundamentally just for exchanges of real property.
Right.
Second, exchanges of personal property, equipment, vehicles, intangible property, patents, trademarks, and cryptocurrency are no longer eligible for 1031 deferral. They're generally taxable sales and purchases now. Tools like bonus depreciation might offset the tax hit on tangibles, but watch out for complexities like state tax differences and ST tax effects.
Why?
Third, even though traditional 1031 is narrowed, other powerful strategies exist. Things like qualified opportunity zone funds for deferring and potentially eliminating various capital gains, using structures like Delaware statutory trusts or NNN properties within a real estate 1031 to shift to passive ownership, exploring deferred sales trusts to spread tax payments, or using U-parts for diversification.
Lots of tools in the toolbox.
And finally, maybe most importantly, understand the specific tax implications of any asset sale or exchange you're considering today. Factor in state laws. And get professional advice from qualified tax and financial advisors to figure out the best fit strategy for you. Don't try to navigate this alone.
Absolutely crucial advice. We've really seen how the rules for swapping assets have changed dramatically, pushing many strategies beyond that traditional broad 1031. But, as tax laws keep evolving, maybe responding to new economic pressures or even newer asset classes we haven't imagined yet, What new forms of tax deferral or investment structures might pop up next? How will investors keep trying to preserve capital and adapt to whatever the next tax landscape looks like? It's something to think about as you look at your own assets and plans.
That need for informed adaptation is definitely the one constant.
Well, that's all the time we have for this deep dive. Thank you so much for walking us through all that complexity.
My pleasure. Always interesting stuff.
We certainly hope this deep dive gave you a clearer picture of Section 131 today and the world of options beyond it. Join us next time for another deep dive.